Tesla is facing one of its biggest challenges yet, as rising tensions between the US and China threaten to derail the company's global growth strategy. New retaliatory tariffs from Beijing are hitting American automakers hard. And for Tesla, the timing couldn't be worse. What began as a promising expansion into the world's largest EV market is now turning into a high-stakes battle for survival. The tariffs have immediate consequences. Tesla's cars, already seen as premium purchases, just got even more expensive in China. Models like the S and X are likely to feel the impact first, but the effects could ripple across the entire lineup. In a country where price matters and local competitors are getting better by the day, a significant price bump could be the difference between dominating the market and losing it. Domestic brands like BYD, NEO, and XPeng are already gaining ground. With government support, lower production costs, and no tariffs to worry about, these companies are positioning themselves as smart, patriotic alternatives to foreign imports. Their vehicles are becoming just as advanced, if not more so, and they're being offered at prices that are increasingly hard to ignore. Meanwhile, Tesla's image in China is shifting. What was once seen as a symbol of innovation and luxury is now starting to look like an overpriced import. Rising nationalist sentiment and a growing push for self-reliance are making life harder for foreign brands. If Tesla can't keep up, it risks losing not just sales, but relevance. The company is now facing a tough decision. It can eat the cost of tariffs and take a hit to profits, or it can raise prices and risk alienating customers. Neither option is ideal, especially at a time when raw material prices are already squeezing margins and demand is softening in other markets. Every move from here on out carries risk. There's also the matter of the supply chain. Tesla's Gigafactory in Shanghai has been critical to meeting global demand, but the current tensions are a reminder of how fragile that system really is. China dominates the market for key EV materials like lithium, cobalt, and nickel. If more export controls are introduced, the entire industry, not just Tesla, could be staring down production slowdowns and rising costs. Long-term, this uncertainty could force Tesla to rethink its commitment to China. The company has poured billions into its operations there, but continued volatility may push leadership to shift focus to other regions like India or Southeast Asia. That would mean rebuilding supply chains, re-establishing manufacturing hubs, and possibly walking away from years of brand building in China. Other global automakers are watching closely. Companies like Ford, GM, and Volkswagen are also heavily invested in China and could soon face similar hurdles. If the trade war continues to escalate, we could see a major shift in how automakers approach international expansion, with many choosing to diversify away from China to reduce exposure. And as Tesla navigates this storm, Chinese EV makers are seizing the opportunity. Backed by government funding and a strong domestic base, they're moving fast. Not just on price, but on innovation too. If Tesla can't keep pace, it risks losing its edge in a market it once led. The coming months will be critical. Elon Musk, known for bold bets and big pivots, will need to steer Tesla through a complex maze of trade policy, consumer behavior, and competitive pressure. The outcome won't just affect Tesla's future in China. It could redefine the trajectory of the global EV industry. Tesla isn't just facing a challenge. It's entering a new era of uncertainty, one where technological innovation alone might not be enough to hold its ground. What's happening in China is more than a trade dispute. It's a seismic shift in the global electric vehicle landscape, and Tesla is caught right in the middle. Just a few years ago, China was the crown jewel in Tesla's global strategy. The Shanghai Gigafactory was a game changer. It slashed production costs, sped up delivery times, and gave the company direct access to the largest EV consumer base on the planet. Tesla wasn't just competing in China, it was dominating. But now that advantage is starting to crack. Beijing's message is clear. The era of rolling out the red carpet for foreign automakers is over. The latest tariffs are just the surface-level symptom. What lies underneath is a major policy pivot. China is now backing its own brands with full force, financially, politically, and culturally. Companies like BYD, XPeng, and NEO are no longer just startups trying to catch up. They're global contenders, and they're being positioned as the future of Chinese innovation. This puts Tesla in a tough spot. The company has built its brand on three key pillars: cutting-edge technology, sleek design, and aggressive pricing. But with tariffs forcing up prices, one of those pillars, affordability, is under threat. If Tesla passes those costs on to Chinese buyers, it risks losing the budget-conscious customers who helped fuel its rise in the market. If it absorbs the costs, profit margins shrink dramatically, putting strain on its financial model. And then there's perception. Tesla has long been the cool brand in China, especially among young urban consumers who value innovation and status. But national pride is a powerful force. With growing economic tensions and calls to support domestic industry, Foreign brands are being reevaluated. In today's China, being foreign doesn't automatically mean being aspirational. In fact, it may become a disadvantage. At the same time, competitors are stepping in with aggressive strategies of their own. BYD, for example, isn't just competing on price, it's competing on performance and features. It recently surpassed Tesla in global EV sales, a symbolic blow that underscores a deeper trend. The center of gravity in the EV world may be shifting east. Elon Musk has never been one to shy away from a challenge. His track record shows a willingness to take risks, disrupt norms, and push boundaries. But this isn't just a regulatory problem or a supply chain hiccup. This is a geopolitical storm. It's a head-on collision between two superpowers, and Tesla is stuck in the crossfire. The question now is, how does a company like Tesla adapt in a world where access to key markets is no longer guaranteed, and where political decisions can upend business plans overnight? One possible path is to diversify, further expand manufacturing into other regions such as India, Southeast Asia, or Latin America. But such a pivot isn't just expensive, it's complicated. It involves negotiating with new governments, building new infrastructure, training new workforces, and navigating a web of new trade regulations. It's a multi-year effort with no guaranteed outcome. Meanwhile, investor sentiment is teetering. Tesla's stock has always been volatile, often swinging wildly based on quarterly earnings, product announcements, or Musk's latest social media post. But this time, the uncertainty is deeper. It's structural. If Tesla is seen as losing ground in China, the market could interpret it as a loss of future growth, and that perception could trigger more aggressive sell-offs and reduce Tesla's ability to raise capital for the long term. There's also the issue of subsidies. China has heavily supported its domestic EV makers through government incentives and funding, giving them a competitive edge. If these incentives grow while Tesla faces mounting barriers, the playing field won't just be uneven, it'll be slanted. Tesla could quickly go from market leader to outsider. This situation also raises broader questions about globalization. For years, Tesla benefited from a world that was increasingly interconnected. Supply chains flowed freely. Markets opened. Governments encouraged international business. But that world is shifting. Economic nationalism is on the rise. Trade wars are back in play. And companies like Tesla, global by design, are finding themselves exposed. What's unfolding now could mark a turning point not just for Tesla, but for the global EV industry. Will companies need to build hyper-localized operations to survive? Will political tensions reshape where cars are made, sold, and driven? And can any one company, no matter how innovative, weather a storm driven by forces it can't control? There's no easy answer. Tesla may still find a way to recalibrate, to refocus, to rebuild its position in China. It may deepen its presence in other regions, tap into new customer bases, and find creative ways to keep prices competitive. Musk may pull another bold move that shifts the narrative yet again. But one thing is clear. The road ahead is no longer smooth. It's uncertain, it's political, and it's full of sharp turns. The decisions Tesla makes in the coming months won't just affect its stock price. They'll shape the future of the company, its global strategy, and possibly the direction of the EV industry as a whole. Because right now, Tesla isn't just navigating a market shift. It's fighting to stay in the race.